Well, good morning. Hope you can all see this and as well as hear me. And I'll have the chat open on another machine so I can follow that along as we go ahead. Uh, that was I really hadn't remembered exactly what was in that YouTube video we just looked at, but for those of you getting new to stock charts, if they are, it's really got to figure out. We'll talk a little bit more about pivots later and why I think they're so powerful. So today, some of you probably attended last week. We talked about the worrisome sort of technical signs that I was seeing. And of course, like often happens, the market was very strong on Monday, opened near the highs for quite a while on Tuesday morning, and that was all she wrote. So somebody on SNN said, well, the selling really started Wednesday afternoon. And I was going, no, really started about 9:35 Tuesday morning. So let's look at some charts. We're using the PowerPoint for part of this, and we'll go to live charts too. So this table is the front of all, the Viper hot stocks and the ETF each issue. And it's sort of, when I put this together, and I just really finished this about 10, 15 minutes ago, it gives me a look at where we are and where we might go. Okay, so each market, these 5 markets, where we closed, the relationship to the quarterly pivot. So you can see at this point, the QQQs and the IWM are both below, their quarterly pivots. SPY, DIA, and NYSE are still above them. Yeah. Then we look at the 20-day EMAs. So, if you were, in this kind of environment, in the type of market, you're looking to establish a short position, start the 20-day EMA, is a potential target. And that's why I conclude, over here, so we're, 3.5, 3.5% below the 20-day EMA. Not really oversold by this, you can get down to 5 to 7% below. But as you can see, then we have the Stark bands. And so, only 249.21, is the weekly Stark band minus Stark band for the Qs. Almost all markets traded below their daily Stark bands on Friday, though they didn't close below them. So that gives you, sort of an idea of, where you are. I mean, and then of course, since last week, all the weekly AD lines except the DIA that follows Jones Industrials closed negative. And it's the only one that's positive. All the daily, it flipped back to negative during the week. And so that's, consistent with what I call being in a corrective mode. So let's look at some charts. Start with the weekly Spider Trust, pretty ugly action. We talked about this bar last week, which didn't look very good to me, frankly, and then we had this spike up, and a weak close below the 20-week, so, you're looking at this level here is about 270, 269, 270. It's the next key level of support. If we break that, then, you have to look to we're heading back towards the Stark band or this lower channel. Interestingly, the 50% retracement, now this is calculated from the COVID low down here, 248.21, so we just about got there at the last low. Oftentimes, and then the 61.8 is at 317.11. Another support level I put in here is 333.34, and that was the high that we formed right before the COVID collapse. And you can see that, at the time I was writing, and why I find the Stark bands are often so valuable. We were trading above the weekly Stark bands before this drop. And of course, we traded well below them, in March and April before we started a rally. So, that kind of gives you AD line has dropped back below its moving average, but still above the lows. So, if we were to somehow get below that last low in a few weeks, the AD line might not form a new low, but that's getting ahead of it a little bit. Let's look at the weekly, the daily chart. You can see that spike. I think the SPY opened at something like 22 or something, 410.22, traded as high as 410.24, and then, bam, the downside. So Right now, we're right in the middle of the at 383.31 between the 38% and the 20 and the 50% levels. Often corrections will end in that, but I think it's too soon for this market particularly. So then we have that 381.80, which is 61%. And you can see the daily AD line also is negative. We have a clear, and you can see that it did not make a new high on Tuesday. One question I sometimes get is, do you look in, and I'm teaching, do you look for divergences when it's, do you use an intraday high or a closing level? Well, obviously, if, we use the closing level, there you wouldn't qualify this as a divergence because we didn't make a new closing high. So I look at both. The answer is, so the fact that we did make a new high and, during the day and the AD formed a lower low, I think still is a type of a negative divergence. So, if we get a snapback rally, the moving average is declining here. So clearly, you draw a trend line across these two. That's where we need to get above at this point to signal a change in trend. QQQs still looks the worst. No question about that. And, so that's something that, it closed below the last 4 weeks lows. And, we have an uptrend here around 265. It's not that far for the Qs, 9 points roughly. The way things move, I mean, we had about a 24-point range last week. So you can get there in a hurry. And of course, if you break that, then you're kind of looking at this, lower support line here, the Stark band here, and the pre-COVID high at 236. AD line, flip back to negative. That's not a surprise. And, it continues looking at, the relative performance. That's the weakest, of the major averages. So the daily chart looks a little more interesting. You can see this green line here. That's the monthly pivot support right around the daily Stark band. So on a short-term basis, that's kind of a target, so if you're, in a inverse ETF, that suggests, we could, we should see a bounce next week. It still won't be that Santa Claus rally because if you didn't see the article I wrote last week in Forbes, really is Santa Claus rally developed by a gentleman by the name of Yale Hirsch, who's the late Yale Hirsch, came up with all sorts of interesting patterns. And it's basically, based on, a bullish trade, 5 days after Christmas to the first 2 days of the new year. That's really what, it keeps getting misrepresented, on the financial press, but so if you want to, you can search Yale, Yale, Hirsch, Hirsh, and you can find out he did some really nice stuff. He's also the kind of the sell in May guy. So even a more negative trend here, I talked about last week that, it already formed lower lows. So, you're kind of looking for a rally failure here. You got it, This is a trade station chart I don't often show, but it's pretty interesting. So the bottom part here is the number of QQQ stocks, which are theoretically 100, that are above their 10-day moving average. Well, as you can see at Friday's close, only 12% or 12 stocks were above. So you can see we get down here to like 5 range here. Doesn't mean we're going to see a bottom, but oftentimes you get a nice sharp snapback rally. So, we could, I pretty much guarantee we'll get down in the 5 area sometime next week, RSI on a short-term basis. So, one of the things why I find pivot so useful, and one thing, even on the, on the hourly charts in stock charts, I do a lot of, historical analysis. I'm fortunate enough to have access to, a number of different platforms, TradeStation, Thinkorswim, Trade Navigator, etc. But for these kind of charts, I really like the fact we have the price. So you can see that, way back in, early in the rally, we took a position around 377, 60 or so. And then I used this horizontal analysis to say, okay, well, let's add to it because the AD numbers were positive right around, I think it was like 371.20 or something. We got down to 367, 10, but not for long. And so we'd sold out part of the position last week, I believe. But this is an interesting spike. So, this is adjusted for the dividend that SPY played. The actual high was like 410.22. So 408.61, you moved right above the R2, which has also been adjusted, for the dividend and fail. So it can really give you sometimes a look at numbers that you don't really come up with these levels using any other analysis, so some of you from last week asked me about that, and that's one of the things I teach. Those of you who listened to me for quite a while, I don't not much in the sales plug, but we will be running some classes in November. 199, 90 minutes. It's a one-on-one thing, and somebody got 2 emails asking me how does it work. So you sign up and pay through PayPal. We set up a phone call with you, and I talk to you, and we see what how I can help you. We do a 90-minute session at least on Zoom, and then there's usually a follow-up call or a Zoom session. So it kind of assesses your skill level and makes you decide whether you want to go forward or not, and learn more. So all my students have been very well satisfied, I think. All right, back to the markets. So, last week we talked about, treasury notes, maybe bottoming, they had that move up, on Monday, and then the rest of the time downward, still, trying to bottom. We have this divergence in the MACD histogram. It was a pretty well-defined top. When you see this sort of histogram, and you also see the weekly is negative, you're pretty confident that, I wrote close to a top in yields. Actually, I produced that article right around in here. I was pretty sure that we were going to get a rally and that the rally would fail. I was more sure the rally would fail than we would get a rally, but I thought it was likely given the other technical factors. So, now, maybe bottoming. Of course, that's not going to help the stock market likely, which seems to be fixated now on a recession. And, based on a couple of reports, I think I mentioned somewhere, that the CPI report was much better than expected. And of course, the retail sales and industrial production and manufacturing data was much worse. But 1 month report, whether great or lousy, doesn't really make a trend. So I'm a little skeptical of the retail sales, given some of the other data I'm looking at, but it could be right. Most of the bearish sentiment in the markets that I've heard is based on that the PE ratio is not low enough to have the correction over. Anyone who's read my stuff for ages will understand that I don't put a lot of weight on PE ratios. Because basically you have some admittedly smart analysts analyzing the data that's provided by a company to forecast what the company's going to do down the road. I prefer hard data. Not saying that the companies are going to mislead the analyst intentionally, but it's sort of, the best quote I saw this many years ago in the Wall Street Journal was that the fundamentals of cocoa were about as firm as a Hershey bar that's been left in the sun. So anyway, I'm not in that camp at this point. So I think this is a correction. There was some surprising stuff last week. We've looked at this before. The AEI bullish, still really at low levels, 24. It probably is significant that we get above this 35 level at some point. We see back in 2020, the fall of 2020, we had this bottoming formation here, and it was pretty choppy. We peaked in early September, plunged down to the end of thing. People just, this was where, all these hedge funds were scrambling to get in tech stocks, and so they boosted up the stock price by buying options. And then we had a secondary push here, and then right around in here, the AD line down here was really strong. You can see it was already making new highs. So, it was a really good setup, and the sentiment surged. So that's kind of what I'm looking for there. NAIM actually got better, up to 71.6, which is not quite the highest level since August, but it's close. So it'll be interesting to see if it continues to move higher this week. That'll suggest that big money managers are starting to buy stocks, which is what they haven't been doing all year. Value growth, it's looking weaker and weaker. We talked about this last week. So major top in November of 21. We're getting down into support here. So in the next couple of months, we get down to this 150 area maybe, and maybe growth will see a rebound. Certainly no signs of it last week with Netflix, etc., hitting the skids. Speaking of value, though, I think that's one of the reasons that the Dow Industrials is looking so much better. So this is a weekly chart of the DIA. I pointed out, but didn't really act on it back in November, right in here, that the RS down here was really starting to look good. And of course, it's outperformed everything, in the past, I guess, 4, 6, 7 weeks, even though it had a reversal too. You can see it made a new high. Anytime you make a higher high and then a lower low, and it opened, as it looks to be a key reversal, that doesn't, on a 2 to 4 week basis, that's, not very positive. The AD line is still barely above its moving average. And so, a lot of these markets I'm looking for ones that have a positive relative performance, and they need a pullback. Last week also, we talked about the relationships of the dollar to a couple of funds. So this was pretty interesting. So in blue, we have the IEV. It's a European ETF. And in red, we have the dollar index. So you can see these gaps, in 2007, 2008, dollar was collapsing. European stocks were doing really well. Also in 2014, dollar was weak. This was 2014, you can see we had this huge gap again. The dollar started to rally, and Europe didn't like it. Okay. A similar gap in 2018. You remember the end of 2018 was that actually that chart you might have seen at the start with that replay from YouTube. Another wide gap. Dollar was weak. That benefited the Europeans. So you look into the big picture, you can't really do it on a short-term basis. And now we have, the dollar was was quite low in 21, quite high up here. So, and now everything it seems to be turning. Dollar peaks and the IEF starts to rebound. So that's kind of, along with the technicals we'll look at IEV, is another reason that I like, I'm looking at some of the overseas markets on a pullback. Of course, everyone talks about gold and the dollar, and it's, you can see that in the high in 2012, identified incidentally by the Stark bands. Monthly Stark band closes above gold right on this part here, and was downhill after that. So, sometimes less clear. Dollar falls here, gold rallies, gold bottoms, rallies, gold falls. So, but it does, you can look at this as, if you're looking at straight the dollar, you can see we're getting right back into some support there. And, but gold is also, and gold, is still in kind of a triangle or a wedge formation. And I'm working on an article should be out maybe later today on gold has an interesting seasonal pattern that bottoms in February. So currently I have people in the GDX and the GLD. GDX is doing pretty good. GLD, not so much. Okay, so strategies to, for 2023. So I've been doing a series on Forbes, and the first two parts are up in the Viper report. And, it's sort of like learning from the financial crisis. What happened, as we talked about value and growth, Many people don't look at it that way, but essentially, growth topped out, in 2000 with the .com and declined until 2007. During that period, value was it. Okay, so that was the value bull market. The bank stocks did great. We talked last week about, some of the fundamental indicators that I can't stand that are still used by the so-called traders on CNBC, like ratio to book value, et cetera. And but they got trashed. And unfortunately, most value or a lot of value advisors, I never try to use ultimates, don't believe in stops. So they got crushed. I mean, I don't remember Bank of America. We can look at it, but it was like, I think it was, well, I know it was like 55 or $60 and went to 5 or lower. So anyway, what I noticed in 0809, I found a link to the article. It was written at about the end of February right in here. And I was noticing that the relative performance, okay, so this is the Jerry Hayes Aspray Insight. It was his idea for a name, not mine. So I put his initials in front of it. Was starting to show signs, just the basic relative performance I talk about in stock charts was starting to bottom out in the QQQs at the end of the bear market. So the bear market made its low here. You can see the QQQs did not make their low. And actually, as the market was falling the last 3 weeks of the decline, it was breaking out here to the upside. That was a sign that tech was going to be the leader in the next bull market. And that continued onward, up until, late last year, basically. And so, that's kind of, this is a fairly this is a combination of the relative performance and price behavior that Jerry A developed. Quite ingenious. So that's what generates the really short-term arrows. I look also at the trend. So, bottoming formation, breakout, so this was key support, which we held throughout the bull market. So also interesting at the same time, sort of the converse of this is IWD, the Russell 100 value. So, the market's, crashing to the low here in March. Look at the analysis of the value stocks. They're still getting trashed. I mean, you can see they were just like, they were bad all the way down. And then for the first couple of years, in the new bull market, you can see we were still in a range. So, I would have been out this level here, you'd have to get above that to signal it was coming a market leader, and that didn't happen. So, what looks interesting now? Well, IWD looks quite a bit different now. It had quite a reversal last week also. So then, the weird term trend is down, but look what it's been doing since 22. It was in this downtrend here. So it's been pretty positive. Obviously you wouldn't want to see it drop below this low, but that still suggests that a pullback in IWD should be, well supported. And that it has a good, if you look at, a lot of these value plays, they have all the, quote, blue chip or the best known companies that should, continue to, have a future anyway. So, so let's look at IEV. We talked about its interrelations with the dollar. And you can see it formed a nice bottom in October too. So it came down, the Aspray Insight came down here, bottomed out, broke this downtrend here. So that was a positive sign. And it just moved above this resistance here. So, that suggests, okay, well, we're at 45. The 20-week EMA is at 43.62. So that's kind of the first level I'm looking at. And then, of course, if you look at what I typically would do and what I typically teach, you just say, okay, well, let's see how we can narrow this down. Let's look at the fib levels. And so that has the fib level, coming in 38% around 43.49 down to 42.22. In terms of chart support, you wouldn't, we shouldn't see it close below that level. So you can see the daily Aspray Insight is looking really strong and, shows no signs yet of topping out. So, that's, something I'll be looking at. Another one that I saw was getting trashed by some of the financial media last week was the industrials. It's sort of the same thing as the Dow stocks. Okay, so a stronger dollar tends to have a negative impact on those big multinational corporations that get a lot of money from overseas. And that's why all these companies have their own, Forex guys, that it's the last time I used to provide a lot of advice in the foreign exchange market. And, I'd get questions like Malaysian beer guy was shipping Malaysian beer to Singapore. So he wanted to know the outlook for the Malaysian, I think it's the ringgit and the Singapore dollar, because he was selling his beer in Malaysian ringgits, and he wanted to know what the differential was, between the two currencies, so he could hedge his exposure. So that goes in a lot. So XLI, it does, also kind of, between 95.25 and whatever this low was, probably about 91.50. There's big reversal and the volume picked up, so it's probably, but you got to remember that the Aspray insight, and the relative performance, it doesn't tell you the direction of the market it's studying. It just tells you how it's doing versus the S&P 500. So it's a relative. You can see up in there, it says this is relative to the SPX. So that's why it's valuable. You'd rather be in market leading stocks. And if you're looking to the short side, you'd rather be in stocks that are acting weaker than the S&P. So when the S&P drops, they'll drop more. And those that are stronger than the S&P, when S&P is up, they'll typically rally more. So a few more chart here questions right now. Haven't seen many, but I put the first two parts of the previous session up on YouTube. This is an indicator that I link to often on my publications. Don't show charts of too much. So it's pretty interesting. So we have, this is the number of S&P 500 stocks above their 20-day EMA. It's really got crushed. I mean, it was above 90%, at the end of November. Now it's down at 20%. So you can see, 20%, you have to look at this in terms of this shorter term, in the context of, well, we get below 10 or something, that's probably going to mean a pretty good rally. The other two, the 50-day and the 200-day are more longer term. So, they'd formed lower highs here. So it's correcting. So what level I'll be watching? I'll be watching down into that 40 level on the 50-day. And also on the 200-day, probably, the 40 to 45 range right down in here. So that will be the levels that I will be looking at down the road. And I think subscribers, you probably have a link to this one if you have stock charts. One of the beauties about stock charts and why I use it often in my teaching is that I send my students the setups on any of these stock charts, they get access to those. So I email them that. They have stock charts. They can open it in their stock charts and save my setup to their version of stock charts, their accounts. They can see it all the time. So a couple questions did come in. Yes, we will be a replay. We are breaking the lows now, or is rally now in the cards? The rally is likely, but not in the cards, and I think it's not going to it's probably not a buying opportunity. I mean, it's I think a more likely a good rally. Even if you look at this chart up here, and you can see like around 39.50. We'll look at the futures live a little while later, but a rally from here, I think it's probably likely to fail unless there's some big shocking development, peace in Ukraine or something. Hard to imagine. There's no real economic data until we got most of that out of the way last week. So let's look at some of the things that don't look pretty for next week. Our Apple. I was thinking back in here, that we had a chance that the overall market was going to think, but you can see these pivot levels. Apple just, Jerry did a really nice thing with one of the many really nice things he did with the 20 period EMA, because I drilled into his brain how important I thought it was, and so he had the thing to program it into rising is blue and falling is yellow, which is really helpful. So right now, for example, Apple has the falling 20-day at 147.78. It's crashed through a couple pivot levels. This is the quarterly pivot, so it's below that quarterly pivot. So it just hit the midpoint here between the quarterly pivot and the S1, which is down, right up about the lower Stark band, and then some further support levels. So probably back in here, about 118, 120 is really major support. This is the first level to watch, which I think was in the high 120s, but we can look at a live chart too. So anyway, the volume here is negative, and the volume picked up last week, so nothing good there. So somebody put in 4,000. Well, I don't know what, a rally to 4,000. Probably not. We can look at some live charts. One question I did get last week, so I'll address that now before we move on to the live charts, etc. Is I've been watching a flag formation in Peabody Energy, which I really very fond of flag formations because they generally work, and also you can get some pretty nice targets. So what I do is typically is like, measure this high, to this low, for one target, the width of that added to the breakout level, or from here down to here for a second breakout level. And so we had a really pretty good entry, or I think right around 2650 or something on BTU. It got up, so it was like up about 18%. And I just didn't see a stop at that point until under here. So I didn't take profits, which I normally recognize. I normally suggest that people do. And one of my faithful clients pointed out in an earlier video that says like, well, don't get greedy. You get a 15 to 17% profit, take it, and look to get back in. So we got stopped out with a 3% profit last week in BTU. And you can see what here's the daily chart. So, right in here, this bar down was probably the best sign that, maybe I should be using a tighter stop, which would have been around 29.13. So I think it was probably $1.50 above where we got out. But I'm actually looking to get back in this, close here. Looks like we could get, back down here. But this bullish, flag formation, I think has some legs. We look at that hourly chart. If I don't always look at the hourly charts on every market that I have a position in, I usually look at them if I think there's a chance it's topping, or if I'm looking to establish a position and want to fine tune my entry, as I showed you with that SPY chart. So, here is this pullback here, and so we had on a weekly basis. The end of the week, we closed. Volume was pretty good on that Friday, and we closed below the next week's pivot. So that was, if I'd noticed that, I hope I would have taken half off at that point, which was, right around 30.50 or so. But, and here's what I'm looking at right now, big volume into the close here on Friday. So, it's still, but you can look at, 26.49, 27.09. There's some pretty good support down there at lower levels. Take any questions? Okay, now you can. Should be seeing the weekly chart of Bank of America right now. Not very pretty. And about the next hope down here is 29.55. It's starting to get pretty oversold. So if you look at a daily chart, it's formed a couple of dojis down here. So if you look at retracements, which is what so whether you're looking to sell it or you're looking to short it, I'd be looking at the fib levels from this high. which would get you back to 34.12 to 34.98. Problem with that would be a stop, typically would be above the 61.8, but with all this supply up here, you probably need to have it, even higher. So that's not looking too good. Let's see what other Bank of America. Okay. Let's look quickly at some of the futures that I often. This is the futures, a bunch of different time periods. So 260 minutes, another Jerry creation, monthly, weekly, daily, and so let's look at the short term here. Pretty wild week. We started out the week short, and we're stopped out here without much damage on the 12th, and hit all three targets on the upside, and then reversed to the short side on the afternoon on Wednesday, and I've hit 2 out of the 3 targets. So the next target on the downside is at 38.29. So it's it's maintaining these midpoints too. Often a pretty, but the stochastic confirmer, those of you who aren't familiar with, is Jerry took George Lane's stochastic and sliced and diced it. Is a good way to turn it into something else. And then the thing I like about it, he put in the linear regression channels. So this is the upper linear regression channel. So those of you who are familiar with channel analysis, you get up in the upper channel. If you're drawing your channel correctly, it's an area that has a high probability of being a top. So he did this on the indicators, because I told him, when I started out, I treated the indicators just like a chart. So I drew trend lines, support, resistance, moving averages, etc. And the whole schmear. So you can see the moving average of the stochastic confirmer. It started turning negative here for all those hours between the early morning on Tuesday, until Wednesday afternoon, and it was declining slightly. The stochastic confirmer was up in the extreme category before the spike high. Now it's it's negative, it's red, but it's down in the area that it could be bottoming. But notice down in here, it could take some time. So let's see if we want to look at AGO. Okay. Not sure where so AGO, big volume on Friday. Of course, let's go look at the weekly first. Stark bands gave you a pretty good clue here. You move it above the upper Stark band 3 weeks ago. So that's, as Manny Stoller devised, this is sort of like not a time to be greedy indicator. You can see back here, did a really good job. 2-week pullback here, 2-week pullback ahead of a top. 2 weeks above the weekly Stark band here is often a time to, take profits, or if you're inclined to trade the other side, that's a time to do it. So let's look at the daily looks on this. Okay, so let's compress a little bit. So if you look at the fib levels on it, you can see it gotten almost down to the 38%. Typically, I would pick an entry point. I would take the 59.07, 56.57, and take the difference in that, which is, my math's correct, that's about 250, $1.25 up from 56.57 is going to give you 82, 57.82 maybe. And then if you 57.82, so like right around in here, then you could use a stop, under one of these lows if you're looking to buy it. You can see the volume, has turned negative. It started turning negative couple, and you can see the daily Stark bands also gave you a pretty, good warning. So before I forget, let's look at Amazon since that was the last request. Well, we'll look at the daily chart first, or the weekly chart rather. This is, still, that's why the relative performance, it's been negative, it was negative from September 14th, a brief positive thing as it bounced, but you can see as we're making a new high, relative performance wasn't, and in June of 21, and even though it's recommended, I think this was an earnings date, had no number of people, a lot of people going, well, this is just the best earnings you've ever seen, and nothing's stopping this stock there. I think if you check back, well, here was earning dates. So right here, yeah, you can see some of these, earnings dates were often fake outs. So when I often don't hold a position through an earning because the market is so fickle and I don't really trust the earnings report. So right now we got to the Stark band, so that's a good sign. No signs of a turn from the volume, or the RS. We look at it daily. Also, heavy volume last week on the downside. So, I mean, I guess we could look at, you really want to look at a monthly chart, maybe going back 4 years or something. It gives you an idea of, we're already in pretty, so 81.67 down to 78. Some support down in there. You can see we got a good signal here right in May. It dropped below that lower Stark band and then, bounced pretty nicely. Where did the bounce end? Right at the 20-month EMA at that point. So still looks pretty sick. I'll get on a couple of people on some other stocks. Really not. So let's look. Oh, forgot. I saw one of the big banks came out and recommended Meta last week. I found surprising. So the monthly chart, not looking too great. It doesn't have the volume on it, but the relative performance is still negative. Let's look at the weekly. Let's look a little more weekly than that. I had a nice bounce. Maybe a selling climax here, 6 weeks ago. But I'd like to see the volume get above this red line here. And, the relative performance still says it's lagging the S&P. So I wouldn't touch it. Baba. Baba got up to, Chinese stocks, had a nice run. You can see it's evident here on the weekly chart. Now pulling back a little bit. Relative performance is trying to bottom out here. Hard to tell,